Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Friday afternoon. We made it and we're speeding along in June, aren't we? Almost through, 3 weeks through, but we have seen weakness coming through in the market today, all to do with the big Australian dragging us lower. So let's have a look at where we are tracking as we round out the week's trade. You can see the CBO 200 there down by 1.1%. The S&P ASX 200 is down 88 points or 1% to 8,823 points. Now we're virtually unchanged over the last 5 days and around 4% off our 52-week high. But Nadine and I were just talking in the close about really how you can see the momentum in healthcare, always considered defensive, just really showing you what the mood of today is. We've seen energy stocks tick up, we've seen consumer staples tick up and consumer discretionary, but this near 4% drag coming through from the materials sector, offsetting any of those gains, including a 1.5% gain from the healthcare sector, and this after BHP warned of these cost blowouts. So coming to our themes of the day, have we seen, drum roll please, because I'm quite proud of this one, BHP? Because of course BHP was trading at record highs before today's some 4% fall, and now you're starting to get all the analyst broker calls coming through. Barclays saying that this blowout in costs at its potash project in Canada is going to weigh on CapEx. We had John Lockton from Sandstone Insights earlier today. You can find that interview online as well. He thinks that there could be more selling coming through, not only in BHP, but also in some of the other big miners like Rio. So of course, it's been the theme of 2026 so far, at least in terms of our market, this upside coming through in the miners, but maybe a little bit of a time for pause, particularly ahead of the upcoming reporting season in August. So we are, as I mentioned, finishing where we started with the index unchanged over the week, and also a reason potentially for a bit of money coming off the table today is that we're about to go into 3 sessions with no Wall Street. So we've got the weekend, but we've also got the Juneteenth holiday, that Freedom Day holiday for June 19, which means that Wall Street will be closed on Friday. Wall Street actually did close higher though on Thursday, rebounding with semiconductor shares leading those gains, and also of course the optimism over the Middle East peace deal. Let's have a look at the sectors of the day, really kicking it off there with the miners. So BHP, wow, dropping by 5% there on the close. Rio Tinto down by more than 2.5%. Fortescue also under pressure because you've got iron ore futures just hovering around that $100 a ton mark. Let's have a look at an ounce, I should say. Let's have a look at some of the gold players there. They also came under pressure. Northern Star down 2.4%, Evolution Mining as well. So gold futures continuing to come under pressure after that hawkish commentary from the new Fed chair, Kevin Warsh, earlier this week, which has really lifted the greenback as well. And having a look at what we're seeing in healthcare stocks, as I mentioned, a real defensive play coming through here, particularly CSL being picked up after being battered so much. It's up 4.7%. ResMed, Telix, Cochlear also higher. Pro Medicus, though, having a bit of a switch out. When it comes to the corporate stories, of course, BHP at the top of the ladder there, saying the cost of expanding its Canadian potash project has risen to $6.9 billion US dollars. The Commonwealth Bank, well, it's appointed Victoria Leder as Group Chief Information Officer, Rodrigo Castillo as Group Chief Technology Officer, Matt Common, the CEO, continuing to really say how much they're expanding into tech, into AI. Macquarie Group also there, it was under pressure, completing the purchase of about 734 million of its shares to fund employee profit share and promotion awards. Heading the other way though, ElectroOptic Systems had a really good session, up 14% after it secured a contract with the UAE defence firm Generation 5, worth almost $177 million. And Sky City Entertainment had a good day. It will pay a $21 million fine in relation to gambling breaches at its Adelaide casino. It's Friday afternoon. It's time to welcome Shane Oliver from AMP to the COB. Shane, great to see you.
Thank you. Great to be here.
So a big week. We had Kevin Warsh kicking things off. A bit of a change of tune there, getting away with forward guidance. I feel like he's taking a guide out of Michelle Bullock's book. And then we also had this this MOU signed between the US and Iran. So just put it all together for us.
Well, overall, it's been a fairly good week in terms of news generally, although that shift towards more hawkishness by the Fed didn't go down too well. But that said, the US week has ended. We've got the public holiday in the US tonight, Juneteenth holiday, so the market's closed, and I think it was up 0.9% for the week. Our market, when I last looked, was around about break even. So overall, it's been good. We've got that good news in terms of the situation in the Middle East. Looks like they have signed the deal, at least electronically. We're starting to see ships go through the Strait of Hormuz again, albeit the numbers are fairly low. So I wouldn't get too excited just yet, but we are heading in the right direction. In Australia, we got the Reserve Bank. They left rates on hold, but still a bit of a hawkish lean on their side. And also in the US, the Fed moving in a more hawkish direction. But overall, it's turned out okay for markets. Economic data's been okay. No great upsets. But there are those clouds on the horizon coming out of the Fed, potentially moving towards rate hikes.
Yeah, absolutely. Although I note that some analysts are now sort of backtracking a bit, saying maybe 2027. When it comes to hopefully getting oil flowing through the Strait of Hormuz, what are we seeing with Brent oil versus the futures market, and what does that tell us?
Well, that come down, I think, about another $10 just over the last week. And Brent oil, as you can see in that chart there, is less than $10 above where it was before the war started on February the 27th. So we have seen a quite sharp fall. A lot of that fall obviously occurred in anticipation of the peace deal, and then there's been a further fall since that deal has been announced and then signed up to. Futures indicate that it might pause here for a little while. I think it is going to take a while for things to fully get back to normal. It'll take a while for the ships to start flowing like they normally do. I know it was J.D. Vance or somebody or other said that there'd been 12 million barrels go through the Strait of Hormuz. That's over the last few days. But normally it's about 20 million barrels per day. So there's still a way to go before we get back to normal. And likewise, even when those ships start flowing again, there's a way to go before it flows through to refineries and we actually see it in refined prices globally. But we are heading in the right direction, and that obviously is good news. The other thing I think is that when you look at that chart there, it sort of suggests a gradual decline after a bit of a pause around these levels, then a gradual decline, still staying above levels seen earlier this year for Brent crude and WTI. I suspect it's somewhere out there, maybe next year, you'll get a situation where supply does pick up more and demand falls. You've seen a boost to demand for EVs, for example, and greater focus on energy efficiencies. And that's been the story after all of the oil shocks over the last 40, 50 years or so, except the first one in 1973. But all those others have been accompanied by weakness at some point down the track, given those supply and demand responses. But I think that's sometime next year before we get to that point. And of course, that does assume that the peace continues in the Middle East, where there is, I have to say, there is a high risk that it hots up again, maybe after the midterms are out of the way, because you can sort of question whether anything has actually been resolved. Some might just say, well, we're back to where we were before on February 27th. Strait of Hormuz back then was open, and the US and Iran were negotiating about Iran's nuclear future, and here we are doing the same thing again.
And I love what you've written in your weekly note as well, which you always give me a bit of a sneak peek. The US in retreat as the world's worst cop. Shane, what does all this mean, though, halfway through the year for major asset classes and where we're sitting? Bitcoin, I know, is very much underperforming a lot of other asset classes.
It certainly is. It's like, on the one hand, I mean, last year was sort of, I guess it came into its own. It was much more accepted by institutions and so on. This year it's been struggling. As you can see from that chart there, it had that fall into February and then another fall into June, and that low in June a few weeks back was actually testing the low back in February. We've had a bit of a bounce in then, but lately it's started to go back down again. That low in February and the one earlier this month was a 50% retracement from the high, which was, I think, in November of last year. And of course, I guess on the one hand, you can sort of be optimistic about Bitcoin and saying it's making a transition to becoming an alternative to gold, digital gold, if you want to put it that way. But by the same token, we also know from Bitcoin's history that every 4 years, roughly, it goes through a crypto winter. And historically, I think we've seen 3 up until now. If you include this one, it's 4. Historically, they've seen peak to trough to falls of 80%, of which we've seen 50% so far. So you can make an argument there's still a bit to go before we hit the bottom. Time will tell on that one. You can make an argument that it's become more institutionalised. So the June, February low may be the bottom, and at the moment we're just bouncing along from that. But we don't really know for sure at this point in time. Obviously, it would be a good sign if it does manage to bottom out here and then move higher. It would suggest that maybe it's moving on from that sort of crypto winter thing that we've seen every 4 years in the past.
And then let's talk about some of the big moves that we saw here this week. The federal government announcing carve-outs for its CGT and trust changes, and Pauline Hanson making her debut at the NPC amidst a protest at the same time that we saw the migration figures released. Tell us what the net migration is actually showing us.
Well, migration numbers collapsed in the COVID pandemic and the lockdowns. At one point there, we saw more people leaving Australia than come in, so population went negative. You can see it in that chart there. The red line is the official number, and of course those other two, the visa numbers and the net permanent and long-term arrivals, are a guide to that. Actually, I should say the teal coloured line, if you want to call it that, it's not green, but it's teal. That's the official number. So the official number peaked at about 550,000 immigrants, I think it was, back in September. So the 12 months to September quarter 2023, and we're currently, it's slowed down to around 301,000 over the 12 months to December last year. So we have seen a slowdown. But when you look at the numbers there, they're still relatively high. Immigration numbers are still relatively high, and therefore, you know, one nation can argue that it's still too high, that there's issues with housing, affordability, and so on, and then partly that relates to immigration. If you look at those other two lines on that chart there, they're sort of sending a mixed signal, but they may be suggesting that maybe if you take a midpoint of those two, that we may not see much further fall in immigration from these levels here. So one is on the high side, the visa numbers are on the low side. If you take an average of the two, they sort of suggest we maybe stay around current levels for a while yet. And that would only fuel this sort of call for immigration levels to be cut back further. So, yeah, we have seen a slowdown. Population growth is now back at 1.5%. That's a more normal level, but the absolute numbers of immigration are still running at relatively high levels. Historically, that can be a bit of a problem to the extent that we're not building enough homes in Australia. On our count, we probably need to be building 200,000 homes a year to keep up with population growth as it is. We're currently running about 175,000 homes in completions anyway. And so therefore we're running behind. And then if we want to get on top of the shortfall of housing that's built up over many years, we probably need to build 240,000 homes a year. And obviously we're running way below that. And that, of course, is the Housing Accord target. So obviously the housing shortage issue remains and is still going to remain an issue for some time to come, unless you see a sharp fall in immigration or a really big pickup in supply. And under current policy settings, both of those seem a little bit unlikely. So I guess the pressure there remains on the government to try and get those immigration levels down. And that, I think, is one of the big drivers behind support for One Nation, along with the other issues around cost of living pressures, a feeling that maybe the mainstream parties aren't delivering, and also social media, which tends to enhance grievance. You know, if I want to get lots of clicks on social media, I don't do some boring economist post. You've got to do something that enhances people. You can do something entertaining like Deanna and myself and me do, or you can do something which rolls up people's grievance, which I don't really like to do. But that's what gets hits on social media, and you could argue One Nation and other populist parties like Trump in the US, Farage in the UK, Le Pen in France. Social media is ideal for them, and so that's sort of amplifying their message to some degree. The thing that concerns me a little bit is if you look at populism historically, it tends to come up with a lot of things that sound like common sense, but like protecting industries or cutting down on immigration and so on and so forth, but it ultimately doesn't really solve the underlying problems. You can see an element of that in the US at present. So that does worry me, and it sort of worries me from the point of view of an investor that populism can lead to an environment which is more inflation prone, less quality growth, and therefore ultimately that could mean lower returns on a longer term basis. Early days yet, way too early to get too concerned about it. And I do think that One Nation have sort of modified a lot of their policies to become a little bit more mainstream than they used to be, which is a good thing. But by the same token, there is a risk if we go down the populist path too fast, or too far and too fast in Australia.
Yeah, a lot there, right? A lot that's happened since One Nation first came to attention about 30 years ago. Quickly, Shane, what's on the agenda for next week economically?
Well, locally, of course, the inflation numbers come out. It's become a bit of a drag now. We get these monthly inflation figures, and so economists like myself have to spend a lot of time looking at inflation. And if we're not doing that, we look at the RBA. So that seems to have become a little bit too much. But most economists would say more is better than less, so that's a good thing. I have a different view. But anyway, CPI is out on Wednesday. It's probably going to show the headline rate staying around current levels, might actually go up a little bit. So the monthly number, when it comes up, probably show a fall of 0.4%, something like that. Fuel prices were down 15% in the month of May. So that's good. Only thing is that a similar number drops out a year ago, so the headline annual rate probably stays around 4.2, or on our estimate maybe goes up a little bit to 4.3%. So not as bad as the 5% that we and others were expecting a few months back, but still pretty elevated. I think the focus, though, will be on the trim mean, and it'll probably show a further rise from 3.4% to 3.5%. So still on the up.
Oh, we might have. Nope.
The reserve. We heard from Reserve Bank Governor Bullock that the inflation numbers so far have been consistent with their forecast. So in our view, that I think is still consistent with the Reserve Bank raising interest rates, which is sort of what the money market is implying on that chart there. The money market's got a 50% chance of another hike this year. We think we will see another hike in August, and there's also some chance we'll see another one beyond that. So that's obviously a main focus. Then we get jobs data, household spending figures on Thursday. Household spending might show ongoing weakness, I think. But and the jobs numbers probably be a little bit okay. Don't forget the numbers in April were on the soft side. We think unemployment will fall back to 4.4% from 4.5% in April. Internationally, not a lot of data out in the US, but we do get the things called PMIs, Purchasing Managers Indicators, and they come out on Tuesday, and they'll give us a good guide in terms of how business is responding, I guess, to the peace deal. And so that could lead to a bit of a bounce in those PMIs, and some of the pressure that we were seeing, which was very high in terms of prices, might start to roll off a little bit, which would be a good sign as well.
And Shane, I know what you like to read, I know what you like to listen to. Are you a soccer fan? Are you going to go up at 5 and watch the Socceroos?
I should say yes, but no, I won't be. I'm look, I think the Socceroos are doing fantastically well, and I wish them all the best, and I'm hopeful, and I think they'll win tomorrow morning. But I'm not that big a fan.
Yeah.
I'm not big a fan enough to get up at 5 a.m. I'll be watching it in more normal hours. So yeah, I'm not that big a fan. I mean, ball games and sport are sort of things that I'd rather watch occasionally, but they're never really my thing. I think my parents sent me to play soccer, like a lot of Australian boys and now girls. When you're young, you get out there on Saturday morning and play soccer, and that's great stuff. But it wasn't really my thing. Boating was more my thing, sailing and that sort of stuff.
I knew we were kindred spirits. Have a great weekend, Shane. I feel the same. But go Socceroos, of course. Shane Oliver there from AMP. All right, getting back to the equity market, the stock of the day was ElectroOptic Systems, and Nadine spoke to our experts, Luke Winchester from Merewether Capital, Claude Walker from A Rich Life.
EOS in the right space. I'll say a hold for the program, Nadine, just because it's one of those ones. I'm sort of coming to it, again on some short research. I know it's one of those real battleground stocks. There was a pretty compelling short report a few months ago. I had a read of that and sort of looked at a few of their points and thought, geez, they always do sound good, but there were some points in there I thought were pretty well made. But then you come out and win contracts like this, it's hard to sort of argue as well. So one that I just prefer to probably stay on the sidelines for, but if you're there, I will say a hold.
But I will discuss why you might want to own it, which is that it's a momentum trade right now. Australia has very, very few genuine defence companies listed on the ASX, and especially not many that are really fully focused on defence. We've seen with Drone Shield how much that hype can just take the share price to crazy heights. Now, both of these companies are definitely in the right spot thematically because drone warfare is the new reality in any active war now. Like, really, a lot of the technology a lot of the countries have is a little outdated now. It's far too expensive. You need cheap ways to shoot down drones.
Kick it off with the laggards, given that it was a down day on the market. DPLO had a weak session, down around 10%. Alcoa, or Abandoned Mining, IGO Hub 24, really just a theme there in terms of a lot of the miners. But it was BHP's market cap that weighed the most on the market. So maybe not a big percentage drop, but a big drop in terms of the overall drag on the market. Let's have a look at the leaders. Did we find any of those? 4D Medical had a good session. IDPEducation, of course, upgraded. We talked about a rotation into health as well. A2 Milk and Life 360 as well. The small end of town, Audinate, Cauldron Energy, Berkeley Energia, Addison and Sky City Entertainment on its update to the market, while the laggards today included Alligator Energy, Atomic Eagle, Cyprium Metals, Bougainville Copper and Nova Minerals. Now, of course, it's June 19th, Juneteenth, as they say. So what is happening elsewhere tonight? Not a lot. In fact, it's blank. So let's see what might be happening next week. We've got that CPI print, of course, for May, the unemployment rate on Thursday, and Thursday evening, the US quarterly GDP. All right, let's get a final check on where the local market is tracking, and we're down 1.1% there on the CBO 200, while the S&P ASX 200, just going to quickly drag it up on my screen, it has finished the day down 0.9%, 8,828, and as Shane mentioned, pretty flat over the last 5 days, but in fact it did just gain slightly, up by 1/3% over the 5 days of trade. Have a great weekend. We'll see you from 9:45 a.m. Eastern on Monday, and of course, go Socceroos.